Hi, what's up, y'all? Okay, I want to talk to y'all about credit builder accounts. All right, I'm gonna make it real short and real sweet, and to the point. Okay, on the credit builder accounts, a lot of people they go with Self, they go with Kickoff, they go with Credit Strong, Credit Sesame, Rent Reporters, Rent Karma. You hear a lot of this stuff on social media about these type of accounts. Well, this is what I want to say. The underwriters, the banks, the credit unions, the people that approve your funding, like everything that's around the financial institution, they have social media too. So they hear those exact things, those exact credit uh, credit builder accounts. They know about them anyway, So they don't hold no weight. They don't hold no weight. So while you study applying and getting these accounts, they don't hold no weight. However, they do report to your credit report. Don't get it twisted. They do report to your credit report. So you will see the account reporting to your credit report. But most of the time it'll be just that. It'll be self reporting rent, self reporting this, when you dealing with self, and when you dealing with boom, it'll be boom, like it'll be them reporting to the credit report, right? And so I don't recommend those accounts because I feel like when you dealing with funding and you go into these applications are going from your bank relationship manager to the underwriters. I know that the underwriters know about those credit building accounts. And what those credit builder accounts say to the underwriters is, A, you either just came out of foreclosure and you're trying to build your credit back up, or B, you just had your credit repaired, and you're trying to rebuild your credit and structure your credit report to achieve the data points that you need to possibly rip us off again, because that's how they see it. When you had bad credit, it's because you had charge-offs, or you had derogatory accounts, or you had late payments. All these things is from you getting funding and then not being responsible with the funding that you received. And so those credit builder accounts say this. That's what it say. So my recommendation is, if you coming out of credit repair, if you coming back, you bouncing back from a bankruptcy, don't advertise it. Don't make it known. So don't fill your credit report up with those type of accounts. But instead, what I preach and what I teach is, go to your local credit union, go to your local bank, go with whatever institution you are with. You got a debit card, you got a bank account, you may have a job, you may have direct deposit, whatever that institution is, go to that institution and ask for a savings secured loan. Okay? Now let's just say that well, first let me tell you what a savings secured loan, in case some people don't know. A savings secured loan is a loan that's secured by the money that you have, right? So if you were to have $500 deposit, let's just say I got direct deposit, I got paid, and I have $500, right? Or $600. And I wanted to do a savings secured loan for 500 of those dollars, right? And so what the bank would do is they would freeze $500 in my account, and they would give me $500. So let's just say I had the direct deposit check. It was $600, and I told the bank I wanted to do a $500 savings secured loan. So they would freeze 500 of that. It would look like they took it out of my account because it wouldn't be present on my bank statement or anything. They would take it out, and then they would give me $500, right? We don't want a secure credit card though. We just want a loan. We want a savings secured loan, right? And so they're gonna take that 500 and they're gonna give me 500. Now, the way they win is they say, okay, how long do you want the savings secured loan for? And I tell them I want it for like a year, right? And so what they do is they break that 500 into 12 payments, because it's 12 months in a year. They divide it by 12 and they get a sum total. Now with that sum total, they add on, or before they do that, they add on their interest. Their interest might be Navy Federal was 2.25. So they would take your $500 balance and they would they would multiply by 2.25. They would get that total, and then they would divide that by 12, because it's a 12 months, and that would tell them how much your monthly payment is, right? And so anyway, that's the bank. That's how they get, your monthly payment. That's how they calculate that. But that's them. That has nothing to do with you. Like what has to do with you is you're getting a $500 savings secure loan, right? And so the key element, or the major factor in getting the savings secure loan, is this: you want to be able that it's a pay and release loan. And if you ask the financial institution, they may not know what that means, because that's not a term that's used. I just made that up, pay and release, because that's what it is. You pay an amount and they release an amount. So if I had a $500 savings secured loan and I paid 100 of it, they are going to release 100. That's a pay and release. Some banks don't do that. Some credit unions don't do that. They do $500 for a year. That's what you want? Okay. Then you're going to pay a certain amount every month, and at the end of that duration of that year, we're going to release your $500 after you have completed the year term. You don't want that. That is not what you want. That is not going to help you. That is not what I teach. What I teach is a pay and release savings secure loan. I know some of y'all may have heard about the Navy Federal hack, the pledge loan. The pledge loan is a savings secure loan. That's all it is. It's exactly a savings secure loan. I don't know why it's called a pledge loan with Navy Federal. I don't know if it has to do with military or whatever, but it's called a pledge loan with them. But it's literally the exact same thing. It's a savings secured loan. So you're going to go to your banking institution. You're going to get a savings secured loan. But this is what you're going to do. You're going to make sure it's a pay and release. If it's a pay and release, good. You're on the right track. So now we're going to apply for that. We're going to get that savings secured loan for whatever amount. Put as much as you can up. If you have to wait till you get paid, wait till you get paid. When you get paid, what you want to do is you want to do the savings secured loan as soon as you get the money up in there, because it's going to take about 48 to 72 hours. And I know you have bills, and I know you have this. If you can't do it for the entire check, then do it for $200. Do it for $300. The point is, it's a primary account that's going to be reported to your credit report. That's the whole point. But you do want to do it as much as you can, so it'll constantly report for as long as it can. See, this is the key. The key is to get the savings secured loan, and once they deposit the money into your account, because remember, they're going to freeze the money and then they're going to deposit the money into your account. Once you get the money in your account, you're going to pay off 95% of the loan. So let's say the loan was $500. I'm going to pay $450 or $475, $480, whatever, $490 if you want to, $488. That leaves $12. That means I'm gonna pay $1 a month. Okay, now you're gonna pay 95% of it. So once you pay 95% of it, what does that do? What that does is it causes your next payment is not to be due until the 12th month, because you paid off 95% of the payment. So you done paid off 11 months worth of that payment. So it's not due until the last month. So what happens now? What happens is every single month on your credit report is going to report as an installment loan that's paid as agreed, paid as agreed, paid as agreed. You ain't even got to do nothing. You don't even need to worry about that. You know what I'm saying? It's going to report every month paid as agreed, because you paid 11 months, right? Plus, you got your $480 or $90, however much you paid. Do not pay $500 if you got a $500 loan. That's retarded. It's just going to close the account out. You want that account to be reporting pay it as agreed every single month. So you can't pay it off. You're going to pay 95% of it. You're going to pay $480, $490, whatever floats your boat. You know, you're going to pay just that amount. You can pay $400 and leave $100. That's up to you. But I need my money, so I'm going to pay as much as I can, 95% of it, and get most of my money back. Because why? Because then I'm going to turn around and run that same play again. I'm going to go to that same bank and I'm going to do another savings secure loan. If I did it for $500 that time, I'm going to do it for $490 this time, and then $480 the next time. And the key element is to do it for different amounts. You don't want to do it for the same amount, because if you look at your credit report, then the underwriters or the loan officers or the people that's viewing your credit report might think that it's a duplicate account if it has the same amount. So you want to make it have different amounts, you know, 500, 490, 480, you know, whatever. You want it to be 5,000 or, you know, 4,500 or 3,000, whatever you can do. But that's what you want to do. So what happens is you'll have this installment account that's reporting to your credit report. But watch this. I'm gonna give y'all a nugget here, man. I don't know why I'm giving y'all this. This is for my clients only. This is this stuff that people pay me for. But when you do those primary accounts, what you can do is you can put a co-applicant on those accounts. Now, what does that do? I'm gonna show you what that do. I did it several times, but this is what they do. Say I go get a savings secured loan. You can get up to 3. So let's just say I go get a savings secured loan for $5,000, right?